Today we'll talk about buying an investment property with a whole life insurance policy. I'll go over exactly how we help our clients use their whole life insurance policies to invest in real estate. First, I'll cover this in concept, and then second, I'll go through an example. So, to begin, someone I speak with might say, I am interested in a whole life insurance policy, and the reason why I'm interested in this is because I heard you could use it to buy real estate. Tell me more. So they get a policy, and the goal is typically 100% cash value. It's very common for me to hear someone say, Steve, I don't care about the death benefit at all. I get it. We'll show you how to maximize your cash value. Why they're interested in the cash value is because that is what they're going to use to buy the property. And the main reason why they do this, the why behind all of it, is because they see that they earn a higher return than what they would have earned if they just buy property with cash or finance a property through a bank. They see that the life insurance policy generates a higher return and is a lot easier too when it comes to accessing their money. So we'll look at an example of someone funding a policy with a total of $500,000. What I will say is it's all relative. We can make that a total of $50,000 or $5 million. As long as the policy is set up properly, it all works almost exactly the same, meaning the guy with $5 million versus $500,000, the only difference is typically the size of the properties that they're acquiring. So if I put $100K per year into a policy for 5 years, what I might see is by the 5th year, my cash value might be worth about $525,000. I'll see a positive cash value if the policy is designed correctly. Now in the 6th year, we're assuming that I pay zero, and my cash value grows to $540,000, and you'll see in the example that our death benefit will be worth about $1.8 million. The 7th year continues to appreciate. I'm paying zero at this point in time. The cash value is now $560,000, and as it continues to grow, by year 14, my cash value is worth more than $750,000, and the death benefit in the example you'll see will be set level at $1.8 million. So the cash value grows safely, I can access it for real estate, and it also has a nice tax benefit, which is a big reason why so many people are attracted to it. What we're going to do, though, is use the policy to purchase an investment property. The price will be $300,000. The return I feel I can generate is 10%, which will generate me $2,500 per month or $30,000 per year. Now, to do this, we're going to take a loan from the policy. We'll take a $300K loan to purchase that property. We are going to pay the loan back. You'll find that there is a ton of flexibility when it comes to repaying loans. Whenever we repay the loan, we like to look at how much of our payment is going to interest, and then how much of our payment is going to principal, which I'll show you exactly how we look at that. So let's see how that $300,000 loan impacted our policy. In year 6 is when we're going to take the loan. We can take them anytime. We're going to take it in year 6 in this example. Before the loan, my cash value in year 6 was $540,000. My death benefit was $1.8 million. After the $300,000 loan, my cash value is $240,000, came down by about $300K, and my death benefit is $1.5 million, came down by about $300K. Here's how it works, and this is a big reason why people do this. Even though I see my cash value drop, was $540, now it's $240, that's how much I can still access, I am still earning dividends and interest on the full $540. Just like owning a piece of real estate, when I take a loan against it, if the fair market value continues to appreciate, the depreciation occurs on the entire property, not just the remaining equity. The same thing happens here. How the insurance company does this is 1, by charging you interest on the loan, just like you would be charged interest on a mortgage, and then 2, they collateralize your death benefit. That's what happens here. Now, we're going to repay the loan. Typically, what we see is someone pay it back with some or all of the income that their investment property is producing. But in this case, you'll see that this guy paid it back faster at $50K per year. You can literally pay back loans however and whenever you want. And the end result will be by the 14th year, his cash value is worth just over $750, and his death benefit is $1.8 million, which is exactly the same it was if he just let it sit and grow. It continues to compound for him. Now, if that's confusing, we're going to look at an actual policy. Sound good? All right. Let's have some fun, shall we? So our case study, exactly as we mentioned, we're going to fund the policy for 5 years, then purchase a $300,000 investment property, and we're going to look at the net return on the policy and also the real estate. First, we'll look at the policy, and then we'll add the real estate so we can see our total return. So, looking at the policy first, just like we explained, we've got $100K per year for 5 years. After the 5th year, we pay zero. By age 50, which is policy year 6, the cash value is about $535,000. By age 58, which is year 14, the cash value is just about $755,000. You'll notice the death benefit is also $1.8 million. So that's what the policy looks like if I don't touch it. Now let's compare that with what it looks like if I borrow and repay. So I'm going to take a $300,000 loan. My cash value was about $540, it was $535 to be precise. Here, it's about $220. Why it's a little bit less is because the cash value is reduced by the amount of the loan, and then they're also accounting for the loan interest the next year of $16,680. But I'm still earning interest on the full $535 in this example. My death benefit is reduced by what? $300,000. It was 1.8, now it's $1.5 million. Then we begin to repay the loan, in this example, $50K per year. Here's what we mentioned earlier. How much of my payment is going to principal? We like to put that in purple because it's purple principal. And then how much is going to interest? This is pulled directly from a life insurance illustration, by the way. I just put it on Excel because I think it's easier to follow, and I can put the colors I like on it too. It just helps me follow. And then the dark red, I've got the loan balance that is shrinking as I'm making payments. The main question is, what does my policy look like after the loan is paid? Here you go. Can you see all that? Let's make it a little bit bigger. It's exactly the same. In the example to the left, with no loans, my cash value, $755, death benefit, $1.8. The example to the right, with loans, it's identical. So, why people we work with do this is because they see that their cash value keeps on compounding, and then at the same time, they can use that cash value in their policy to purchase real estate while it keeps compounding, usually somewhere between 4 and 5%. That's how people use their whole life insurance policies to buy real estate. They earn a return on their policy. They then use that money in their policy to earn a return on real estate. Sometimes I hear something like this. And they also don't have to deal with a bank or institution. Sound good? Yeah, it sounds good to me. But what's the catch? Know your numbers, because this can go south. Have you ever heard, put your money in a whole life insurance policy, get a dividend of 5.5% to 6%, and borrow against it at 5%, and you've got a positive spread? It doesn't really work like that. Here's how we can really see if it works for us. Look at your cash value growth, your cost to borrow, and your return on real estate. Now, if I went through that too fast, here's what we're doing. We're seeing how much the insurance company pays you every year. That's total dividends and interest. How much you pay the insurance company every year. That's in total loan interest. And then how much income you receive from your real estate. Add them all up, gives you your total return. Let's go through one at a time. First, I've got the cash value growth. Let's begin with the first year. Something very, very important to point out here. The first year, you pay $100,000. Your cash value is $92,000 and change. The dividend rate with this company is over 6%. Did you earn 6%? You lost money because you have less than the $100,000 you paid in. This is often the drawback that everyone tries to hide or doesn't talk about that much. The fact that I am negative initially, and it takes a few years to get my money back. By the 4th year, I've paid in 400 and I've got just about 400. So I'm still running a loss initially. If I look at the 10th year, my cash value is $636,000. The 11th year, I pay 0. My cash value grows to $663,000. That means it grew by a total of $27,000 just for year 11. That's the cash value growth. This isolates how much money you received from the insurance company in 1 year. Make sense? Loan interest. This is pretty simple. We usually know how much we're paying in interest. If I look at the $300,000 loan, at its peak, when I'm paying interest on the full $300,000, I pay $16,680. The loan interest is what I paid in interest to the insurance company in 1 year. Then I've got the real estate return. If you're in real estate, you know how this works. Got my property value, 10% return in this particular example gives me $30,000 per year. The real estate return is just what I'm getting in income on an annual basis. That's what we're looking at here. So, how we like to look at the numbers. This is how you get your true net returns, and where someone says, hey, this makes sense, I want to do it because the numbers speak to me, or it doesn't make sense because the numbers speak to me. Let's look at year 7, mainly because this is when the interest was the highest as far as what I paid to the company. I earned $23,886, meaning that's the yearly cash value growth. I paid $16,680. That's what I paid to the insurance company in loan interest. Cash value growth minus loan interest equals my net, $7,200. If I go out and buy a car with this, I'm positive $7,200. So I have a positive return in the policy. Important note, if I made this loan $400,000, I'd be very close to a wash in this particular example. The amount you borrow does have an impact on that spread. I like to look at that very closely with the real estate investors we work with. We've got a loan workbook we share with them so they can see this and play around with the models on their own. But that's my net earnings. Now let's add the real estate to the equation. So again, to go over how the process works. I've got my whole life insurance policy, take a loan to buy the real estate because it's earning a 10% return, which comes out to $30K per year. So I'm going to add that to the equation, and that gives me my total return in dollars, and we are just looking at this on a year-to-year basis. Another step I like to take is to look at the total return in the policy and the real estate and total interest I paid. We're just going to look at it on a yearly basis. The totals make it look even better in this example. So here we go. Net earnings in the policy, $7,200. Real estate return, $30,000. The net return just for year 7, $37,206. And again, that was year 7 when the interest was the highest. What about when the loan's paid off? At the bottom of this chart. Well, my cash value growth is $33,453. I don't pay anything in interest. The real estate is still producing $30,000. Add the two together, $63,000 and change. Do I have to pay taxes on the cash value buildup in a life insurance policy? I don't. And I can get it out tax-free too. Through loans, in retirement, you can use withdrawals. You can mess a policy up and have to pay taxes too. If you'd like more information on that, I would just search taxes on our YouTube channel and you'll see some tax rules around cash value life insurance products. Back to the real estate. I earn dividends and interest on my entire cash value. When I take a loan, I only pay interest on the loan balance, but then that loan that I take to purchase real estate, I'm also earning a return on that real estate. The lesson is that my money keeps on compounding even when I leverage the money. Want a quick recap? let's pretend you're a doctor. It's going to be anyone. We'll pretend you're a doctor here. So you put money into a whole life insurance policy. It earns between 4 to 5%. Then you see a property and say, I want that property because it's earning 10%. So to get that property, you take a loan from your policy in order to acquire it, and then you take some or all of the earnings to repay the loan, while at the same time you're earning 5% there, 10% here, all with the same dollar that you initially seeded the life insurance policy with. We just also need to factor in the cost to borrow. My money keeps compounding. So why real estate investors do this, like what they always express to us, like the 30-second overview, is, Steve, it's a safe place to put money that I can easily access, knowing that it keeps compounding and it's tax-free. Like, that is why I do it. And frankly, I have a ton of fun with it too, educating and going over how it works, because there's a lot of things you can do. So with all of that said, if you would like to see how this could work for you, what I will say is we've got some resources here. Not supposed to be there, but that's okay. Got the book coming out soon. I'm super pumped. I've been working on it for years, and it's finally ready. We also have our free guide, which you'll see a link below how you could access this guide. There's a preview of the book. And then if you'd like to see some numbers too, before connecting with us, a lot of times people we work with say, hey, can you show me a sample before I talk? I'm kind of like that myself, where I just want to wrap my mind around a personalized scenario. We do have a form. You can provide some of your information, and what it does is it asks you a few questions, and it lets us prepare illustrations for you. You can add a little note in there as well as far as what you're interested in. And then if you'd like to email back and forth or connect over a quick call, sometimes when someone completes the form, I've got questions, so I call them or text them quick and say, hey, we're working on this. Is this exactly what you wanted to see? Or we can build it out over a quick like Google Meet or Zoom call or something like that. And then we'll schedule something more formal if it's a fit. But we like to do that. So with all of that said, thank you so much. Really appreciate you watching this video on how you could use a whole life insurance policy to invest in real estate. And what I'll say is if you have questions, please leave them in the comments below. Or you can email me. I did have my email up there. It's steve.parisi@ibcglobalinc.com. Or you could DM me. You can reach out to our company direct, whatever you prefer, as we would always like to talk to you about whole life insurance and specifically real estate. We do have a heavy focus on real estate investors and just making sure that everything is done right, from the initial setup, company selection, policy design, flexibility, so it never feels like a burden that they've got to make these big premiums every year, and then also how loans work, looking at the net numbers, making sure it's convenient with access to the online portal, all of those important things that a lot of people might take for granted, but if it's me, I want to be able to access my money quick. I don't want to have to feel like I've got to ask an agent for permission. So we go over all of that, and then when issues pop up, we've got our team that reaches directly out to the insurance company to help our clients have as little stress as possible. All right, I'm going to stop here because I've been talking a lot. Thank you so much for watching all the way through, and as always, I hope this helps.